Well, overseas now, Japan's Nikkei has been hitting multi-decade highs, attracting the attention of many market watchers, including here in Australia. For more on this, Jack Lowenstein, the Managing Director and Co-Chief Investment Officer of Morphic Asset Management, joins me live from our CBD studio in Sydney. Jack, good to see you. Thanks for joining us.
Good to see you, Helen.
Now, Japan's Nikkei, it hits its highest level, since the mid-90s.
Yeah, it's amazing, isn't it?
Yeah, it's been going on for a while, but what actually happened after Mr. Abe won again?
Well, it continued to rise post the election. It rose ahead of the election, and it's risen since. And the yen has also been a little bit weak, which is consistent with what we expected.
Yeah, so you're very heavily into Japan. You picked it early. Why are you still so keen?
Look, it's fundamentally a very cheap stock. To put it in context, the market's nearly doubled since Abe came into power 4.5 years ago. But on the other hand, corporate earnings have nearly doubled as well. So it's not as though it's re-rated. So it is one of the cheapest markets in the world.
All right, but you think it's well-founded?
I do think it's well-founded because I think that what's happening, obviously the monetary policy has been very loose, and that certainly helped everybody feel better. But I think more importantly, businesses in Japan have been forced to reform. So many businesses in Japan that used to be very lazy about cutting unprofitable divisions and so on have had to axe divisions because they're short of staff and they want to reapply their staff to where they can make money.
Okay, now you are overweight in Japanese stocks.
Yes, we are, and we're mostly focused on basically two themes. One is real estate, primarily housing-related stocks, and the other is IT and services.
All right. Now, isn't housing, just intrinsically sort of potentially risky?
It's funny you should say that, because if you ask the average Japanese person, they'll do the very Japanese thing of going and say yes. But the reality is that unlike in Australia, where you pay less to rent than you pay on interest for your home loan, in Japan, it costs roughly half as much in terms of interest and principal repayments to own a home as to rent one.
But they still prefer renting.
They still prefer renting because they're so scarred by the folk memories of the big Japanese property bubble that really burst in the late 80s and 1990.
Right.
The people who weren't even born then will tell you how risky it is to invest in property.
All right, so why are you in it?
Because we do think inflation will eventually emerge in Japan. We're seeing some asset price inflation already. So while everybody's telling you that property prices will never go up, they've actually gone up about 7% a year for the last 4 or 5 years in central Tokyo, which, by the way, is how much they've gone up on average over the last 40-odd years in Australia. And they're still way off their highs. And we think that as more households are formed, primarily by the big increase in women who work in Japan, there'll be more and more demand for condominiums in central Tokyo.
Yeah, now that's been such an interesting progression, I suppose, hasn't it? This number of women in Japan who are working. Tell us about how that will impact on the sorts of stocks that you are investing in and seeing good earnings.
If I can, Helen, just give you some data, really fascinating data points. So there are 6% more workers in Tokyo now than there were 5 years ago.
So does that mean, is that just population growth, or?
There's a little bit of population growth in Tokyo as opposed to the rest of Japan, but it's mostly caused by this big pickup in the number of people choosing to work, primarily women. But it's a huge increase.
Yeah, it's a huge increase. And of course, they do not have immigration, do they?
They have zero immigration, exactly. So how's it feeding in? What it means is that a 25-year-old woman who might have lived at home with her parents until she got married is now not living at home with her parents, is not getting married, and is necessarily at that early an age, and is living in an apartment on her own, preferably in central Tokyo, where she can go out and cafes and restaurants and bars and be close to work. And that's why there's such a big pickup in the number of condominiums being sold in Tokyo.
Okay, so you're not, well, unlike here where we're going to have a guest later in the program, there's quite a lot of concern about a glut in apartments in this country. You don't see any of that problem in Japan, particularly in Tokyo?
No, I don't. And I think what's fascinating is that there's now a big focus outside Tokyo on refurbishing old houses. So there's a company that's coming to list on the stock market in Japan shortly on a ridiculous multiple, over 20 times, I believe, that all it does is buy up used houses in rural areas, refurbish them and resell them. So that gives you an idea that the smarter guys in the stock market are beginning to realize the opportunities there.
All right, now you also said you're interested in e-tech, e-commerce, those sorts of companies?
Yes, I think that one of the side effects of expectations of a labour shortage and the need to reapply what labour you have to productive areas is that the Japanese are moving, perhaps somewhat belatedly, to a more internet-enabled service economy. So one of the stocks we own is a company called Macromill that's done very well for us, which is actually a world leader in digital market research. So instead of going out and knocking on people's doors or filling in paper forms or having people coming into your office to do surveys, they do it all online. And they are very big in Japan, but they're increasingly big also in Europe and US.
Yeah, now I know that it's sort of, let's get back to Abenomics. Now it's been going for some time. He's just won a resounding victory again. What does the sort of continuation of Abenomics really mean for investors? And has he made any real meaningful gains?
Look, he has, as I said before, corporate profits have nearly doubled since he came to power.
But in a sense, that wouldn't be hard because they were so moribund, weren't they?
That's true, but to do that, he had to create the environment in which serious corporate governance reform had to occur. Now, we think that's only just beginning. At the moment, what you've got is corporate governance in the sense of people looking after your money better, but they're still not giving it back to you at the rate they should. So dividend payout ratios in Japan are still only about 30%. There's really no justification for them being less than 50%. If they raise dividends to a 50% payout ratio, the stock market's going to go up another 30 to 40% just on that alone.
And why don't they do that?
Because again, I've never known, I've been investing in Japan and visiting Japan for over 30 years. I have never known people who get so caught up in long-term history. Japanese companies, many of them nearly went bust during the stock market bubble bursting in 1990. So they're very, very keen to retain cash to make sure they don't go bust again, because that's very, very unpleasant for business leaders, as you know.
Okay.
But what's interesting about it was one of the opposition parties, the so-called Party of Hope, led by the Tokyo governor, was recommending or proposing a tax on undistributed profits. Now, it didn't get up. I don't think that will ever get up, but I think the message is clear to corporate Japan. You need to start paying out more of your profits and dividends. All
right, so do you think that's going to happen? You said it could, it'll put another rocket under the share market if and when it does, but is it likely to happen?
Like most of these things, it will happen slowly, and we'll wake up one day and suddenly it's 40%, and then the payout ratio will be 50%, and then we'll be calling for it to be 60%. But it will happen, and the question is, can we be patient enough to enjoy it?
All right, but then, you might not say this as a fund manager and an investor, but we are having this conversation in Australia and elsewhere about, too much money is paid in dividends, particularly with some of our big companies, and people come to depend on it, and they're not perhaps reinvesting enough.
Well, companies have got three choices. They can invest, they can pay out dividends, they can invest in capital capital expansion, or they can just sit on the cash. Now, I don't mind if they pay out the dividends. I don't mind if they do sensible capital investment. But what I don't like is what they do in Japan, which is sit on the cash.
Right.
So
don't they
nobody.
Yeah. Don't they reinvest it in their R&D or?
Well, certainly many of them do, and there is a strong R&D culture in Japan. But the reality is, most successful businesses have got this constant problem of the cash piling up on their balance sheet, which means that their return on equity starts to fall, even though their businesses are going very well. And that's what I think many people in Japan are upset about, and I think what the focus on corporate governance reform will move to over the next year or two.
All right, so just back to Abenomics, that's more on the business side. What's the next step you think he really needs to attack?
I do think pressure on companies to start paying out more in dividends is one point. I think there will be increasing pressure from the market to pay more in wages, which will in turn help consumption. And I think that the third thing is that he's doing, which I think is very smart, is they've decided to divert some of the money they're going to get from an increase in the sales tax, equivalent to GST here, from just paying down debt to investing in education, particularly preschool education, to try and encourage people to have more children and to try and deal with this population cliff that will hit over the next 20 or 30 years.
All right, Jack Lowenstein from Morphic Asset Management, thanks so much for joining us.
Great to be here.